Recording in progress.
Okay, we'd like.
Thank you. Let's give it a couple more minutes. See if Robert gets on. He was on a few minutes ago, so let's just wait about a minute or two. Bobby, how are you today?
I'm well, thank you.
Good, good. Tim, how are you doing?
I'm doing okay.
Good.
Excited about it. It's been a very busy summer.
Well, it's 9:01. We do have a quorum, so why don't we get started, and then Robert joins in. He can just join us in progress. So let me call this meeting to order of the Investment Advisory Committee meeting scheduled for Wednesday, August 25th at 9 a.m. Call the meeting to order. And the first item on the agenda is citizen communication. We did not get anyone wanting to comment, so let's move on to item number 2. Consideration of possible action to approve the minutes of February 25th, 2021. I cannot remember back that far, so I don't have any changes. Does anybody have any changes to the minutes? If there are none, is there a motion to approve?
Motion to approve is published.
Is there a second? Second. All in favor, say aye.
Aye.
Aye. Motion carries. Today we have Matt joining us from TCG. Matt, welcome. You want to introduce some of the other folks that I think you have with you?
Yeah, thank you very much for having me here today. I appreciate it. It's good to be with you all this morning. My name is Matt Escalante with TCG. I'm one of the senior vice presidents. I've been with TCG for about 15 years now in a variety of different roles. My most current role over the last few years is to be the leader of the institutional advisory team that kind of develops these reports about the plan, such as you have here at Harlingen, the 401A plan, and just make sure that ongoing service and support and the fiduciary responsibility of the plan is being accomplished for this group. I just want to introduce Macy Dunnigan. Macy is one of our institutional advisors. She helped prepare the report and has helped prepare reports in the past and supported Garrett in the past and Blake and so forth, as so very familiar with the plan, and has over the last few years taken a role as an institutional advisor in her own right. So again, we appreciate y'all inviting us to have be a part of this conversation today, and are excited to share the report when the time is right.
Okay. Well, we're on item number 3, which is review of economic outlook and performance. Do you have a copy of the packet that Blake sent out to everybody?
I do have it in front of me. I'd be happy to share the screen if that works for everybody.
Yeah, that'll be fine. Go ahead.
Great. Are you seeing the quarterly investment review?
Yes, we can see.
Okay, great. Perfect. So, what I want to do here is, as we go through the meeting, is start with the market commentary. The market commentary serves as a good precedent and discussion, because obviously the way the markets are interacting is affecting the underlying investments inside of the 401A. So we'll review, and a lot of these different points we'll look at the quarterly data, but there will be some points where we'll reference other trailing returns, maybe a year to date, 1 year, 3 year, 5 year, and so forth. But looking at the second quarter of 2021, we really continue to see this positive performance across all markets. If you kind of step back to what was going on in the second quarter of 2021, you'll remember that we were still kind of in the early stages of vaccine rollouts. And at that point, some of the folks that were deemed more at risk were able to get the vaccines, but others were not. So it's still kind of a scarce commodity that was out there. And obviously with the thought back in that quarter of vaccines rolling out, led to some optimism in the market about just reopening and recovery and all that kind of stuff. We've seen how that has ebbed and flowed since we saw a lot of positive things, but of course now we're in the Delta variant, and that is affecting things as well. But for the large part, when we look at the U.S. stock market, outperformed the international stock markets as a whole. U.S. up 8.24%. Global real estate really led the way. The bond markets were a positive performer for the quarter, even though if you think back to the first quarter of 2021 was one of the worst quarters. We see that down here, down 3.4% in the first quarter, but we had a positive return here in the second quarter. So some rebound of the negative impact we saw on the bond markets. I just want to dive a little bit more deeply into the indexes, and so we can take these markets so we can break them down a little bit more specifically into different areas. We talked about the U.S. stock market kind of leading the way and doing well. We see that represented up towards the top with the S&P 500, representing kind of the larger company stock market. We have the Russell 1000 also representing large companies, Russell 3000 representing medium-sized companies, all kind of domiciled there within the U.S., so up there towards the top. We did mention that there was a little bit of an outlier in a positive way with the global real estate. So we see the Real Estate Investment Trust, the REIT, up 11.76%. And the rest of them kind of just, all positive for the most part, as we talked about. But definitely a strong variance between what was going on the fixed income side and the equity side. So digging into the U.S. stock market as a whole, on the top right, we see what performance was for the quarter. The best performing area of the U.S. stock market was large growth. So large companies with a more growth-oriented tilt that were up just under 12%. It's a little bit different than what we have seen in previous quarters, to where we were seeing a lot more positive performance over the fourth quarter of 2020, the first quarter of 2021. We were seeing a lot of our growth coming back from actually the smaller companies with a more value-oriented tilt. And if you remember, that was an area that was hit particularly hard during the beginning of the pandemic and the economic shutdown and so forth. Those really rattled back quickly in that kind of 6-month period. But the larger companies, the more growth-oriented companies have showed a pretty positive return there. Year to date, we still see that. I talked about small cap value doing well. It was the best performing asset class in the U.S. Year to date, so the first 6 months of 2021. It was also the best performing area for the last 12 months, which is interesting to see. But if you flash over to the 3-year number, you can see that it's actually the worst area over the last 3 years. So you look at this tremendously positive run we've seen in small cap value over the last 12 months, it's still catching up to what we're seeing on this in large cap growth. So even when we're looking inside the U.S. stock market as a whole, taking out what's going on internationally, we can see a lot of variance between the market cap of the companies and whether they're more of a growth or value oriented stock. And I think that's important, because we're always talking with folks inside of these plans about diversification, and this kind of shows you why, because we probably want to have some exposure to all of these different areas. International stock market, kind of the same, where large cap outperformed small cap, more growth-oriented stocks outperform value-oriented stocks. And again, this is a shift from what we saw in the last 2 quarters. The numbers here aren't quite as dramatic, but we do see that, again, more value-oriented stocks have outperformed year to date. Smaller company stocks have outperformed on the 1 year. But again, we look out to that 3-year period, we can see stuff that's more growth-oriented still continues to lead the way over the trailing returns 3-year plus. On the fixed income side, so looking at our bonds, right here we have the Treasury yield curve. We did see a shift in the curve pretty dramatically. If you look at where we were a year ago, we can see that represented here in the gray bar compared to the green bar. We can see that rates, did go up over the time. The yield curve started to get a little bit more steep, but if we look from quarter to quarter, we see that rates actually did go down, especially on the further out on the yield curve. So anything kind of 5-year plus in duration, we did see a change in rates there. That affects obviously the fixed income elements of our overall portfolio. We see for the quarter, things that more longer in duration, they tended to perform a little bit better with higher returns, whereas we see things that are shorter in nature, 3-month, 1 year, 1 to 5 year. We can see they didn't perform quite as much because there was not quite as much of a change over the quarter. So we're always looking at the relationship of risk and return. And as we noted, with a really positive equity performance over the quarter, anything that was 100% stock would have been up around 7.53%. As we would allocate more fixed income into our portfolios, we are taking less risk. And with less, we would expect less return in a positive market there. So we see some of these period returns. And of course, you've seen this graph. Just the difference in volatility that somebody would experience over time if they had invested in something either 100% stocks or 100% treasuries, and a little bit of a different ride that they would experience along the way. And we see different events that happened over time. Here we have the financial crisis in 08, this very steep, but very, this V shape that is very steep, very quick down, very quick up. This has been our path since over the last 18 months, basically, with the pandemic and so forth. So really interesting to see how that fluctuates over time. Any questions on the market commentary that I can answer for the group?
Anybody have any questions? No?
Great. So moving into the investments more specifically, I really like this page, this state of affairs. I think it's interesting to see. So really good news on the investment side is we have nothing on watch and we have nothing on replace. So the investments in the plan have done really well, and therefore this is a little bit of a boring review. There's not a whole lot of excitement because things are doing so well in terms of the investments. So we look at it, nothing on watch, nothing on replace. We look at our weighted average expense ratio is 0.10. So 10 basis points is what the average participant is paying for participating in the plan. That's tremendously low. That's something that we want to see. It's really low, and we're going to see some comparisons as we move through the report. We use FI 360 as our fiduciary scoring criteria as our initial wave. I'm sure you're familiar with the process to where lower scores are better. So to have a 10 out of 100, so basically we're in the top 10 percentile of overall fiduciary score for the investments inside of the program, which is fantastic. We always want to be living in this place to where we're in the top quartile, so 25 or lower, and you're at a 10. So if we can consistently be in this spot, we're doing really good for the participants in the plan. Breaking it down, the money in the plan, there's just a little over $13 million. The majority of folks are invested into the allocation funds. Those would be the target date funds, and we'll show you that in the further breakdown. But there are some folks that have broken out some of their money and invested in some of the other asset class options. So there's a total of 23 investment options inside of the plan for folks. So we have our total asset amount. We know that we have 23 investments and we have 0 on watch or replace, which is great. Inside of the U.S. equity side, we have about just over 1%, about $150,000 of assets where people have directed a portion of their portfolio there. On the international equity side, we have just under $8,000, or a really small fraction of the overall investment allocated there. But the majority of assets, as you can see, live here within these target date funds, which we're actually really a big fan of. These are already have a investment allocation that is made up of stocks and bonds based off when people are anticipating to retire. these things, if somebody was put into one of these funds or selected one of these funds, they change over time as well. They get more conservative as we get closer to that targeted retirement date, therefore making the portfolio just appropriate for where they're at different stages of their proximity to retirement. So there's 12.3 million in there, just over 94% of the total assets in these TIA target date funds that have really performed well and are really low cost. So that's good news for folks in the plan. A little bit of money in fixed income and a small amount in stable value. Any questions on kind of that overall holding summary in the structure or the composition of the investment lineup from that perspective?
The loan section that you have, we've got 515,000. Is that outstanding loans in the portfolio?
Correct. Yes,
okay.
That's the outstanding dollar amount.
Okay. Any questions from the board? No. Okay. No questions.
Great. So as we went through our scoring criteria, of course, we added all the funds. We reviewed them here. There's 11 different scoring criteria, which I think are really important. So we're not just looking at based off return and cost. We're looking at manager tenure and how much they're managing, the composition of the underlying investments and things such as that. That creates that kind of aggregate fiduciary score. As we went through that, we really didn't have anything terribly exciting in a good way to where we had generally low scores. We did have one outlier here, which is the BlackRock Russell 2000 Growth Index with a score of 68. We did not put that on watch. And as we get a little bit further in the report, I'm going to walk you through the rationale of why we're not recommending that specific fund for watch list and so forth. A part of that is we can, based off these scoring criteria, we can figure out what are the things that are specifically driving the score. So here's one of them right now. NA represents net assets under management. So the score is being affected by having less than $75 million under management and so forth. So if we're looking at overall process and philosophy and all these different things, those are probably going to have heavier weight to me personally than something like just the net amount of assets under management that we have with this manager. We did have a little bit of a higher risk-adjusted return than the peer group. And we did have a underperformance. I'm going to caveat that I just want to be really specific here. We had an underperformance against the peer group, but not against the benchmark. And I think that's really important when we're looking at this specific fund. And I'll walk you through a little bit more of the specifics and we can look at the numbers. But overall, our funds, they scored out well. They provided us low fiduciary scores, nothing to be terribly concerned about. And, we talked about, over 94% of the assets living here within these target date funds. These have all scored very well. They've historically scored very well over their 5-year average fiduciary scores. So we're very pleased, even in the volatility of the last 18 months with the pandemic. They have continued to be really good funds for the employees here. On this next section of the report, of course, we bring in the fiduciary scores. We start to break them down a little bit more specifically by their specific asset classes. One thing I like to review on this report specifically is how much are we paying for these underlying investments. So we have the BlackRock Equity Index. We have the BlackRock Russell 1000. The BlackRock Equity Index, we're paying 4 basis points, so 0.04, less than 0.1%. That puts it in the top 4 percentile of its peer group. We have the BlackRock Russell 1000 at 0.08, but it's in the top 6 percentile. The median is 0.76. So if the median is 0.76 and we're at 0.04 and 0.08, we know that these are really low cost investments for folks participating in the plan. So they're keeping more of their own money, which should be important to them because it's important to us. As we look through all of these investments, we see again, very, very good score in terms of their expense ratio, top 6 percentile, top 5 percentile, top 2 percentile. All these on this check, everything turned out really well. And of course, that leads to the positive scoring. We do have where the majority of the money is in the TLI cycle index funds. Those are at 10 basis points, so 0.1%. So we really like that cost structure. On this report here is where we start to pull in more of the period returns. We start to look at this. We start to do a comparison of the fund itself, and we look at obviously the trailing returns. We start to compare that with this row, which is the median. The median is going to represent is what is the peer group doing? What are other funds that are invested the same way? How are we ranking against them? And then every fund has a benchmark. The benchmark is basically what are they trying to either meet or beat in terms of overall performance. So we have a pretty good example here of the BlackRock Equity Index, which returned for the quarter 8.56%, which beat the peer group, which was at 8%. So we beat it by just over 0.5%. And then we have the benchmark at 8.53%. So we were in line, just a slight, tiny beat there. So really good stuff. We compare that to the year to date. We compare that to the 1 year, 3 year, 5 year. And again, that goes in our FI 360 score. We're looking for long-term data to basically support that these are good funds that are available inside of the plan. Down here is the fund that had the fiduciary score of 68. This BlackRock Russell 2000 Growth. We can see that the fund had a little, so this is where it's really important to distinguish the relationship of the performance versus the benchmark and the peer group. So this fund for the quarter returned 0.39. The benchmark, which this fund is trying to match, you can see the benchmark is in the name. Russell 2000 Growth, the benchmark is Russell 2000 Growth. So we're essentially, with this fund, trying to match what that benchmark is doing. This is a passively managed fund. And did we do that? Yes, we're at 0.39, we're at 0.391. So that's exactly what we wanted. If we look at the year to date, we're very close, just slightly off, but within a really close tolerance. A little underperformance on the 1 year, but on all of the 3, 5, and 10, you can see just how close we are in terms of the match of the performance versus the benchmark. That is what we were asking for this manager to do in this specific spot. Where the scoring starts to hurt is when you look at the performance versus the peer group. And the peer group is going to be made up of all of the other fund managers that are passively managing their money or actively managing the money. Passive meaning like this one, we're just trying to match the benchmark, or actively meaning that we're actively trying to beat the benchmark. So in this particular case, over some extended periods of time, we have seen that the fund has underperformed the peer group, but we know during these time periods is in this specific asset class, which is small cap growth, is that actively managed funds in this peer group have just outperformed the benchmark as a whole. Generally, what we are seeing, our stance has been, for the most part, is we're generally passive. We generally like passive management. And you see that in these funds, they're low cost. We're looking to meet the benchmarks. We're doing all that stuff. For the majority and majority of asset classes, that's going to be the best place to be in your large companies, your medium-sized companies. Passive investment is where we want to be, and we see that proven time over time. However, there are some asset classes where active management does have some opportunity to outperform, and it's generally the more volatile asset class. So in this case, we have small cap, so small companies in places like emerging markets, in places like fixed income, where the environment just might be a little bit more volatile. It's political. There's all these factors that are gonna potentially, again, it provides some volatility into that specific asset class. And this is a spot where we've seen it. So our thought process is, if we put in this fund knowing that it was low cost, but we know we wanted it to mirror the benchmark, is should we penalize it significantly for underperforming against the peer group in an asset class where active managers have just done better at this point in time? I know I kind of just went through a lot right there. Does that make sense?
I have a question. What is the total investment that we have in the Russell 2000?
Oh, it's very little.
9,000?
Yeah, it's right here. It's just over 9,000.
Yeah.
Yeah. But I just wanted to, does that thought process make sense of, even though the score is looking a little high, of, why we wouldn't necessarily want to penalize a fund manager that is basically doing what we want them to do in a market where this specific asset class just happens to be performing better for the active managers?
Well, one of the reasons that I think we switched to the passively managed funds was because of the lower fees. So,
yeah,
I don't really have any concerns about that particular one. Anybody on the board have any questions?
No.
It does spark a little bit of a conversation and an appetite of the committee on changing fund options. We can see that there's not a whole lot of utilization in these options kind of outside of the allocation funds, but it does potentially spark a conversation of, within some of these asset classes, the ones I rattled off, small cap, emerging markets, fixed income, do we want to potentially add a active option? We can do an analysis. We can provide some recommendations on an active option in these spots where active might just happen to outperform the benchmark.
The opinion, no. I don't think active over time will. They may have their day, but over time, no. And so I like what we've got set up now.
I agree, because we were actively managed some time ago, but then we switched to these passively managed accounts. And I think we've been doing really well. I don't think we should make any changes right now. I agree with Bob.
No, perfect. I'm all for that. I just wanted to run that by you and give you that option to make an adjustment to the design if desired. I wanted to get to, yes, we don't have anything on watch. You can see a little bit of our trailing history of our watch list over the last 6 quarters. So we did have that Russell 2000 growth on watch for a little bit. We had the BlackRock's emerging markets on growth for a little bit, but it looked like we didn't take any specific action. We did have some of the bond funds on watch for a short period of time. So I just want to give you this plan summary for the quarter. So we began the quarter with $11,951,565.46. Employees made contributions of just under $275,000. The employer made contributions of just over $300,000. We did have withdrawals of $181,000. So folks that had separated from employment were eligible, took money out. We had earnings from dividends and interest of just over $6,500. We had unrealized gains. So this is the appreciation in market value of those underlying investments, and the plan of over $670,000. Expenses come from the expense ratios that we talked about. So a pretty small amount considering the value of the overall plan. And so that gave us that just over $13 million in assets. Your average participant balance is $20,482. You began the period with 621 folks with a balance. 417 made contributions. 25 entered, 11 left. That gave you 635 participants with a balance at the end of the period.
Any questions from the board so far?
Nope.
Some of these are a little redundant. I think this is an interesting perspective. You can see how many participants are in some of these investment options, which I think is just good to know. You can see obviously the majority of it in your target date funds, which is a positive thing. Yeah, let's see. Yeah, it looks like we had 109 service calls over the quarter. The majority for PIN changes, some for personal information changes, but just gives you an idea of some of the ways that we assisted your employees.
Up to 2000 growth index fund had 3 participants, was what I gathered from that previous rundown.
I'm sorry, I really had a hard time understanding that question.
The BlackRock Russell 2000 growth fund, that's the one that had the score of 68 that we discussed at some length. That $9,000 in that fund is spread among 3 participants.
Yeah, there's 3 participants in that fund.
Yeah. That's all.
Okay. So
that is the report for you.
Okay, we just covered the review of economic outlook and performance. Item number 3, we also covered item number 4, review current plan assets and participation by TCG advisors. Let's move on to item number 5, review and approve recommended investment allocation and evaluation. Is there a motion to approve the investments?
So move.
Is there a second?
Second.
All in favor say aye.
Aye.
Aye. Any opposed? Motion carries. Okay, item number 6, discuss and approve actions need to take regarding the 401A plan due to the city's reentry into TMRS. Okay, Matt, we're gonna probably need somebody from TCG to come down to talk to the participants about what to do regarding their investments in the plan. Matter of fact, I had an employee ask me this morning, what do I do? And my response was, you don't do anything. You leave your money in the plan because it's earning. It's safe. So I think we need somebody from your group to come down, and it doesn't have to be September, but I think this year we need to have somebody down here to explain that just because we're moving to TMRS doesn't mean that you have to take your money out. It's safe here. It's generating money. It's low fee. So I think we need to stress that to the employees. We could do it through Zoom, but I think it's better if we have somebody down here. Maybe we can meet with a larger group. But I think it's important to stress that to the employees that they don't have to make any changes, that this is still an option for them to look forward to when they retire. And I think our last contribution, according to HR, was going to be in the first paycheck in September. Is that correct, Efren?
Yes, sir. The September 2nd payroll was TCG.
Okay. Okay. Now we're still going to need to continue to meet, monitor the investments, and I think one of the things that we also need to explain to the employees that if you take your money out, you're going to be assessed a 10% penalty, and that's going to be substantial. So I think those things we need to cover with everyone that's in TCG now, and it's going to be transferred over to TMRS. Any thoughts on that?
Yeah, absolutely. That's it's pretty straightforward and easy to do. We have we have a gentleman in the Valley, Sean Romero, he's there. So it's very easy to find some time within his schedule to do obviously a series of group meetings that are appropriate, but also have him available to schedule any one-on-one opportunities to folks if they should want it.
Okay. And just as an FYI, you also started the review of the 457K plans that we have here in the city. We have 3. ICMA, which switched to Mission Square, Nationwide, and Valak. I think we're going to downsize to 2, but you're going to provide options on which others to perhaps bring in and which to remove. So I'm looking forward to that because that's going to reduce the fees that some of the employees have. And I think the investment in those 3 funds is comparable to that of TCG, if I remember the numbers correctly. I don't recall offhand. Do you, Efren? How much the total value was in those 457s?
Could be around 10 million. I'm not sure.
Okay. Well, it's pretty close. So there's a sizable amount of funds that we have in the 457. So I'm looking forward to getting that underway and completed, so we can start saving some of on the fee side for the employees, and that's going to be for the city and for Waterworks also.
Yeah, absolutely. Our team will be preparing all that stuff for you.
Okay. Any questions from the board or anyone else?
I do have one question. The questions coming to us are, some employees are wondering, with the change, do they have the opportunity? Would they need to? I guess there's a variety of motivations or concerns about the TCG funds. Are they able to roll that over into some other vehicle that they have? I think those are the sets of questions that perhaps to be answered by Sean and doing some of the local meetings. But just in general, what answer would there be for that question in the interim?
Yeah, I believe that the plan is not terminating. Therefore, in that instance, as soon as people become eligible, separation from service, whatever it is, like that's when they could move. They could roll over the money to another provider, but there's got to be some kind of a qualifying event to do so. Just like any other type of plan.
And I think that's important. When you come down, we can stress that to the employees, and you just can't roll it over. There's got to be some sort of qualifying event that has to be you to do that.
Right.
So I think in the meantime, if you could come up with some dates that you might be able to have your staff down here meet with us, we can try to set up a meeting area for the employees to come in and just talk to him about their options and what to do. So,
and when should we target for this?
I'm sorry?
And what time frame should we target for this?
Well, I think we need to do something sooner rather than later. So I think once we switch to TMRS, which will be next month, so maybe sometime in September or October.
Okay.
Come down. We could. Because the sooner they hear from us and from you, I think the karma there'll be about not wanting to take their money out or do something drastic with it. So.
Yeah.
Okay.
Yeah, and there are some. I mean, just the way the rules are set up globally. I mean, there are some safe. They can't necessarily, even if they're still employed, just come in and say, "Hey, give me my money." In the sense of withdrawal, like again, there's got to be some kind of qualifying event, separation from service, aging out, all that kind of stuff. So, but again, that's a part of the education process to let them know when it's appropriate to be able to request a transfer out of the plan.
Okay, so maybe if you could give us some dates, and I think it's going to be a process that takes over several days to complete. And I think it's great that your employees down here in the Valley, so we can provide a few days for him to show up and just meet with our employees throughout the day about those issues they may have.
Yeah, and on the one-on-one part of it, because we often get a lot of people once we have a group event, is the wanting to have a one-off conversation. Is he can do that. If you have an office inside of one of your buildings, or if there's other locations he can go to, like, and kind of set aside dedicated days to different locations. He can also do those virtually on Zoom as well, and set that up. There may be some employee groups that are really happy with Zoom and can do that. There may be some employee groups that are going to be more comfortable working in person. So we're happy to work on that with you.
I would venture to say the majority of people here are probably going to be in person.
Okay.
The employees out in the field, they're going to want to talk to somebody.
For sure.
He can speak Spanish, right?
I'm not sure on his Spanish level.
Okay. Well, Efren can interpret for himself.
Sure.
Okay. Any questions from the board before we set the next meeting date? No? Okay, so that would be Everybody's okay with the time at 9 o'clock?
Yes.
Yes. So we can either meet on the November, well, no, 21st on today. What about November the 17th? How's that for everybody?
I think it's fine. I'll look at my calendar right after this meeting.
Okay. We'll send out a calendar invite. If anybody has any concerns or you can't make it, just let us know and we'll try to find another date. But for now, let's set it for November 17th at 9 a.m. And with that, I think we are adjourned. Everyone, thank you so much for your participation and your time. I really appreciate it.